Good morning and good afternoon and good evening, wherever you are in the world. Thank you for joining us at this International Banking Seminar hosted by the Group of 30, convened by the Group of 30. We're meeting today for the first time in a virtual format for obvious reasons. As many of you know, for many years now, we've been meeting annually at the Inter-American Development Bank in Washington on the Sunday immediately after the IMF World Bank meetings, the fall meetings. This time it's necessarily different, but I do want to thank IDB President, our new IDB President, Mauricio Clever Caron, for being here with us today and for being very supportive of the long-term tradition that the IDB has had in hosting us, which I'm sure we'll be able to resume next year, touch wood. Let me say a word about this seminar. This is a webinar, invitation only, as has been our tradition. However, the proceedings are being live streamed, both on the Group of 30's YouTube channel, as well as on Bloomberg. So there is a larger group outside the webinar that will be following the proceedings. It is on the record and the media is with us. As usual, the International Banking Seminar will be co-chaired by myself, Tharman Shanmugaratnam, as chair of the Group of 30, and Dr. Jacob Frankel, who is chair of the Board of Trustees of the Group of 30. And Jacob and I have agreed that I will chair and moderate the panels before Jacob gives concluding remarks. Our speakers will be making opening statements of 8 to 10 minutes each. And then we'll have a moderated question and answer session after that. And that's important because in the webinar format, which most of you are familiar with, but I should emphasize this, you can submit questions at any time using the Q&A button. Now, depending on which device you're using, the Q&A button is either on the top or the bottom of the screen. But do use the Q&A button at any stage. You don't need to wait until we start the open discussion. You can key in your questions at any point and we'll be on the lookout for them. The two panels that we have this morning touch on issues that are on all our minds, whether central bankers, finance ministers, or economic policymakers in the broader sense. They concern not just the short term, not just about dealing with the immediate crisis brought about by the pandemic, but also with the medium to longer term questions that we're all beginning to address. We know this is not just a sharp cyclical downturn. We know we are also entering a new world, a new structural future. And the first panel this morning is on rebuilding and sustaining growth. We have with us four of the world's leading central bankers, and I should say leading economic policymakers: Christine Lagarde, President of the European Central Bank; Haruhiko Kuroda, Governor of the Bank of Japan; Yi Kang, Governor of the People's Bank of China; and Andrew Bailey, Governor of the Bank of England. Our speakers will be delivering their remarks in that order. So let me go straight to Christine Lagarde. Christine, the floor is yours. You're still muted.
Can you hear me now?
Yes, we can.
Good. Okay. It's lovely to see you all on screen. And Tharman, thank you so much for introducing. Let me go straight into the matter that I would like to discuss with you this morning, which has to do with services. And it's a bit unusual, but I think it's particularly relevant in the current crisis that we are trying to navigate. Clearly, in the first part of the coronavirus crisis, it was an extraordinary challenge for public policy, but policy responses around the world converged fairly quickly. Governments everywhere acted swiftly to offset the loss of private sector income through massive fiscal interventions. Central banks around the world, through good cooperation, I have to say, stabilized financial markets and financing conditions, and within our respective mandates, we worked hand in hand with fiscal authorities to absorb the shock. And I don't think we should be shy about it. The results were remarkable and averted what would have been a catastrophic depression. But today, the challenges facing economic policy are broader. The COVID-19 recession simultaneously calls on us to avoid structural damage and to encourage structural change. That's what I would like to discuss this morning or this afternoon, wherever we are. We need supportive policies to remain in place for as long as needed to avoid scarring of the economy and rising inequality. However, by the same token, we also need to acknowledge the permanent changes that are taking place. And in order to extract as much benefit as we can from them, start transforming the economy now. The potential for both structural damage and structural change results from the unprecedented impact of the COVID-19 recession on the service sector. Now, it's going to be easy, given the crowd that we form around this screen, to try to remember a little bit. Compare what we have seen in the first half of this year, 2020, with what we all saw in the 6 months following the Lehman Brothers crash. From the third quarter of 2008 to the first quarter of 2009, services contributed minus 1.7 percentage points to the recession in the euro area, and manufacturing contributed minus 2.8 percentage points. That was back in 2008. Fast forward and look at the first half of this year. The loss was minus 9.8% for services and only minus 3.2 percentage points for manufacturing. And this has implications from three perspectives: the health of the labor market, the strength of the recovery, and the distributional effects of the recession. Let's look at the labor market first briefly. Services are the most job-rich part of the economy, accounting for almost 75% of employment in euro area countries, putting a greater share of the workforce at risk. Second, the recovery. Research finds that the recovery from a services-led recession can be slower than from a durables-led recession, as the latter creates more pent-up demand through deferred purchases. A car that you did not buy in March, you're going to buy it in September. But the vacation that you could not take in May, you're not going to take it in October. And indeed, even demand for consumer goods in the euro area softened in the summer months after bouncing back briefly in May and June, confirming the absence of widespread pent-up demand. Now let's look at the distributional aspects. A services-led recession, especially one driven by social distancing in high-contact sectors, you can all think of what they are, tends to increase inequality. At the peak of the crisis, 40% of income for the poorest Europeans was coming from sectors that were heavily affected by COVID-19, compared with 16% for the richest. According to one estimate, 2 months of lockdown, which we all experience, at least in this part of the world, followed by 6 months with an economy operating only at 80% of capacity, could increase the Gini coefficient by almost 14% in Europe. And this, of course, feeds back into the recovery that I was just mentioning, since lower income households have a higher propensity to consume. So in this context, it is clear that both fiscal support and monetary policy support have to remain in place for as long as necessary and that cliff effects must be avoided by all means. Otherwise, we risk hysteresis in the labour market, an unnecessary loss of viable businesses, and greater inequality. And the recovery in the euro area remains uncertain, uneven, and incomplete, while the new coronavirus-related restrictions currently being introduced throughout most member states in Europe will add to uncertainty for both firms and families. Now, in the face of that, fiscal authorities are already taking action. If I look at my big four, that is Germany, France, Italy, and Spain, they have extended their short-time work schemes into next year. Our analysis finds that at the peak of the crisis, such schemes halved the share of firms under liquidity stress and reduced employment at risk by almost 2/3. This week, just past, European governments also have announced their planned fiscal measures for 2021, which have been voted into law, but which on the face of it suggest member states plan to provide sizable fiscal support to economies next year in 2021. All the conditions are in place for monetary policy and fiscal policy to continue working together. Consider that. The GDP-weighted sovereign yield curve in the euro area is in negative territory for all maturities up to 10 years. And our forward guidance on our asset purchase programs and interest rates provides clarity for governments on the future path of interest rates. But precisely because COVID-19 recession has affected services so deeply, it will also herald structural change. Now, there is always some rotation of businesses during downturns, we'll know that. But with the pandemic, it's different. It is accelerating the pre-existing spread of digitalization in ways that look set to permanently reshape our economies and our societies. And it has certainly raised the level of concern of our population about climate change, about the necessity to protect the environment and its biodiversity. Nearly 50% of Europeans say that they have worked from home during the pandemic. And of those 50%, 18% are in favor of full return to office. Only 18%, which means that the rest are in favor of either continuing the way they have, a minority as well, and most are a mixed model yet to be implemented in many corners. E-commerce increased by almost 1/5 in terms of volume of sales between February and August 2020, and online payments have surged. Digitalization has advanced on a massive scale in areas like education, medicine, to reduce human interaction and increase resilience. In the United States, only 11% of consumers used telemedicine in 2019. But that number has increased to 46% during the pandemic, and 76% are interested in using it going forward. Now, this presents a possible future of higher productivity growth, less carbon-intensive lifestyles, and more democratized access to essential services, if it is dealt with appropriately and properly. And there is also a transitional change. In a more digital, post-pandemic economy, people will still visit shops and consume in-person services, stay in hotels and travel for business or pleasure, but possibly on a smaller scale than before. I don't know how many of you are re-examining their traveling projects for the next 12 months or so, but I would bet you that you are probably going to look at a decline compared with what we had done in the past, and this applies across the board. Sectors such as accommodation, food services, transportation could be lastingly affected. In the euro area alone, these sectors have been responsible for almost 1/5 of the jobs created since 2013. So not only do we need to protect all jobs, but we also need, more importantly, to create new ones that reflect the new patterns of demand after the pandemic. And since this takes time and may require some adjustments, think about training, for instance, because we don't know exactly where demand will be focused, we must at least create the conditions for experimentation and innovation today and recognize that there will be failure as a result of it. The key, in my view, is to empower young firms. In the United States, new firms represent only 10% of all firms in a given year, but they are responsible for almost 30% of productivity growth. New firms are also the engine of job growth. On average, firms up to 5 years old account for only 1/5 of employment, but they're responsible for almost half of the jobs created. In Europe, firm creation has slowed. In Italy, for example, there have been 37,000 fewer failed companies in the first half of this year compared with the same period last year. Now, there are multiple reasons for that. But there are also 52,000 fewer companies that were created. Now, there is no contradiction between continuing to support the economy and encouraging its transformation. For new and innovative firms to grow, they need macroeconomic policies that support demand, because when uncertainty is too high, a wait-and-see attitude stops the most productive firms from expanding. They also need microeconomic policies that encourage firm entry and exit and the reallocation of resources across the economy. For example, the negative effects of onerous business conditions like poor contract enforcement, lengthy bankruptcy procedures are much stronger and harmful for new firms than they are for incumbent firms. This is, in my view, the direction in which policy ultimately has to move. It needs to be focused not only on protection, but also on transformation, not only on preserving the economy as it is, but also on creating new jobs and new sources of growth. In this way, we can encourage structural change while minimizing structural damage, which is the path we must take if our economies are to emerge from this crisis stronger. Thank you for listening.
Unmute. Thanks very much, Christine. That was an exceptionally clear framework that you've provided us, and the way you've traced out the way policy has to evolve, moving from just protection to transformation, is something that's occupying us everywhere in the world. So thank you very much for that very clear presentation. We move now to Governor Kuroda.
Yes, thank you, Mr. Chairman. Today, I will talk about how monetary policy can contribute to rebuilding and sustaining an economy faced with the COVID-19 shock, with a focus on the situation in Japan. Let me first give an overview of the global economic situation. The current crisis has created unprecedented fluctuations in the global economy, triggered by the exogenous shock of COVID-19 and caused by artificially ceasing economic activities through an economic lockdown that was taken from a public health perspective. As public health measures have been eased, the global economy has recovered from the dip in springs. However, the pace of recovery will remain moderate while people continue to be vigilant against the pandemic. The effects of COVID-19 on Japan's economy are no exception. Economic activity has been gradually recovering after bottoming out in the second quarter. Exports and industrial production have turned to a pickup, notably in the automobile sector. Private consumption has also picked up gradually, supported by the government's special cash payments. Looking ahead, while aiming to balance both the conduct of targeted preventive measures and improving economic activity, Japan's economy is likely to follow an improving trend. However, this outlook is highly uncertain and risks are skewed to the downside. If growth expectations drop and financial system becomes unstable, the economy could fall into a full-fledged recession. Therefore, we need to pay attention to such second-round effects of the COVID shock and take whatever necessary measures to avoid their materialization. I would like to turn to policy responses. The Bank of Japan has been taking a variety of measures. These responses have had positive effects together with the active efforts by financial institutions. Funding conditions of business firms have remained accommodative, and the year-on-year rate of increase in the amount outstanding of bank lending has been at a 30-year high, while that of CP and corporate bonds have been exceeding 10%. In this situation, we have not seen a surge in the number of corporate bankruptcies or in the number of unemployed. The fact that these measures have been effective is a big difference from the time of the global financial crisis, when there was increased downward pressure from the financial side on the real economy. In addition, due to the quick and significant responses by governments and central banks around the world, global financial and capital markets seem to have regained stability within a short period of time. I would like to emphasize that coordinated action taken by governments and central banks in the face of COVID-19 have been effective. Let me touch on 2 points. The first is about measures to support corporate finance. In this regard, the globally shared understanding is that the central bank provides liquidity and the government provides solvency support. In Japan, the government has provided credit guarantees on loans made by private financial institutions to small and medium-sized firms, while the Bank of Japan has provided funds on favorable terms to those institutions through its special program. In responding to the emergency situation, such cooperation has been working well. In addition, our swift and effective responses have been made possible by making use of various tools that Japan has accumulated to respond to deflation and the global financial crisis. It is worth noting that our enhanced toolbox has also been effective during the latest crisis. The second point is about the policy mix of fiscal and monetary policies. The Japanese government has conducted economic measures at an unprecedented scale, totaling 234 trillion yen, which substantially exceed the measures taken in response to the global financial crisis. Meanwhile, the Bank of Japan has maintained interest rates at low levels by actively purchasing JGBs. Thus, the policy mix has been achieved effectively. In this regard, the Bank of Japan's yield curve control is a framework that effectively facilitates cooperation with the government while maintaining central bank independence. This framework enables the government to take advantage of the low interest rate environment to issue a large amount of JGBs for carrying out its economic measures in response to COVID-19. However, it is the BOJ that determines the interest rate target as part of its monetary policy. In this way, it is important for the government and the central bank to cooperate while fulfilling their respective roles. Nevertheless, we should keep in mind that the economic and the financial effects of COVID-19 are highly uncertain, and the BOJ will not hesitate to take additional measures if necessary to support the economy. So far, I have talked about the policy responses to COVID-19. Looking ahead, in order to achieve sustainable economic growth, it is essential to reform the economic structure to raise productivity while balancing containment of the pandemic and economic activity. To this end, the government's growth strategy and the innovation in the private sector are expected to play pivotal roles. The accommodative financial conditions would also help by facilitating firms' effort towards such reforms and alleviating the pain accompanying them. Meanwhile, a rise in the potential growth rate and the natural rate of interest as a result of structural changes could increase the effectiveness of monetary policy. Therefore, coordination between monetary policy and structural reform is also important. The current economic situation is indeed a difficult one. However, it is also an opportunity to promote structural changes in order to raise productivity. Moves toward digitalization represent one good example of an economic tailwind. In Japan, with a view to containing the spread of the pandemic, we are seeing new initiatives that make increased use of ICT, such as telework and online medical care. Japan's new Prime Minister, in view of the post-COVID economy, has expressed that the government will work on advancing regulatory reforms. He has also set out plans to further accelerate digitalization, such as establishing an agency in charge of digital transformation. In this way, lessons learned from the current crisis are expected to contribute to strengthening the growth potential of the economy. As for the subject of digitalization, I will finish my remarks by touching on the Bank of Japan's thinking on central bank digital currency, or CBDC. The Bank of Japan currently has no plan to issue CBDC. However, there is a possibility of a surge in public demand for general purpose CBDC going forward, considering the rapid development of technological innovation. We think CBDC could function as a payment platform alongside cash and also serve as the basis for private payment service providers to offer various new payment services. This could lead to the establishment of stable and efficient payment and settlement systems suitable for a digital society. On this basis, the BOJ considers it important to prepare thoroughly to respond to changes in circumstances in an appropriate manner and has stepped up its efforts in this area. As part of these efforts, last week, we published the Bank of Japan's approach to central bank digital currency, which includes the schedule for experiments on the technical feasibility of the core functions and features required for CBDC. Such experiments will be started next spring. The Bank of Japan will also continue to deepen its understanding of the impact of CBDC issuance and on cutting-edge technology, while closely coordinating with other central banks and various stakeholders in the public and private sector. Thank you.
Thank you very much, Governor Kuroda, for that very broad presentation, including the last point, the last issue which you raised on CBDCs, which again, is a theme that is occupying all of us. We move now to Governor Yi Kang.
Thank you, Tarman. It is a pleasure to attend this G30 35th International Banking Seminar on COVID-19. I think effective control of COVID-19 is the precondition for steady economic recovery. We have adopted a comprehensive, strict, and very flexible measures to stop the contagion. Right now, China has basically put COVID-19 under control, and the daily number of imported cases is a very small number. Going forward, China will continue to carry out COVID-19 control on a regular basis and in a well-targeted manner, and improve testing, tracing, quarantine, treatment of the disease to prevent any possible resurgence in the future. I'd like to touch the following points. The first is on Chinese economy. The COVID-19 pandemic has had an unprecedented impact on Chinese economy. The first quarter GDP growth of China is negative 6.8%. However, the economy recovered fairly quickly. The second quarter growth is a positive 3.2%. And the third quarter GDP data will be coming next week. I think the accumulative growth for the first 3 quarters of this year will be positive, meaning that the third quarter GDP on a year-on-year basis is much higher than the second quarter. So that for the whole year this year, we predict that China GDP growth rate will be around 2%. Our price level is stable. CPI is 1.7%, and PPI, Producer Price Index, is still negative. The export and the import has been basically stable, and also our employment situation is basically stable. The surveyed urban unemployment rate right now is 5.6%. The peak of unemployment was in February, which was 6.2%. So from February's 6.2% to now 5.6% for unemployment rate. Second point is on the macroeconomic policy response. We have a proactive fiscal policy, and the augmented fiscal deficit is fairly significant. And this year, the new element of the fiscal policy is to reduce and delay Social Security tax. So that help a lot of enterprises, especially small and micro enterprises. On the monetary front, People's Bank of China, we have accommodative monetary policy to support the economy, and in terms of quantity, in terms of cutting the interest rate, and also in terms of the structural instrument to help. So far, the People's Bank of China has provided over 9 trillion renminbi liquidity, about 9% of GDP, which is equivalent to more than 1.3 trillion US dollar. And also those operations are through open market operations, central bank lending windows, and also targeted require reserve cuts. Our priority is focusing on small and medium enterprises. The People's Bank of China help to provide liquidity facilities and also incentive mechanism to make the commercial bank have the incentive to provide bank loans to small and medium enterprises. And the encouraged amount of the bank loan is below 10 million renminbi, which is about 1.5 million US dollar. And if a bank provide those small loans to small and medium enterprises, the central bank will give some lump sum incentive to the commercial bank. And this is basically ask a commercial bank to take the credit risk. At the same time, make the market resources to be the main force of resources allocation. Commercial bank pick up the enterprise, therefore to avoid administrative management. And that really help a lot of millions of small and medium enterprises. And also in terms of macro monetary aggregate, at the end of September, broad money M2 is 10.9% on a year-on-year basis. And also the outstanding bank lending grow at about 13% year-on-year basis. Third, the future risk and the policy orientation. In general, Chinese economy remains resilient with great potential. Continued recovery is anticipated, which will benefit the global recovery. I think that the main risk right now we see is one is a macro leverage ratio is increasing. The other is a possibility of increasing of non-performance loans of the banking system. And for those two risks, we have been research the effective measures to deal with those two risks in the future. For the future policy orientation, we will emphasize the domestic demand, and the domestic market will play a bigger role in the future aggregate demand. Consumption contribute more to the GDP growth. In the meantime, China will continue to open up the financial sector and to improve the business environment to attract more foreign investment and financial institution located in China. The last point I want to talk is about the debt problem. China has made a big progress in the G20 DSSI. We have supported the extension of DSSI. China financial institutions, especially the policy bank, Exim Bank, has reached agreements for DSSI for about 20 countries debtor financial institution. And on the debt treatment beyond the DSSI, they support a coordinated case-by-case approach to the debt restructuring for eligible countries. A good framework not only considers the elevation of the current debt burden, but also provide future incentive to encourage financial institutions to make more loans in the future for the needy countries. And I think a good common framework, we already agreed on the G20 should address the following three issues. First is elevation of the current debt burden. Second is provide the more loans for the future and make the debt issue sustainable. Third is provide a flexible enough framework to deal with case-by-case difficult problems. we have to consider on the creditor side. On the creditor side in China, each of our policy bank, development bank, and the commercial bank, insurance companies involved, is an independent market entity. They have their own capital requirements, regulatory requirements, and also budget constraints. Those financial institutions raise funds from the marketplaces. We have to carefully define the borderline between government official behavior and the market entity behavior and the market entity budget constraint. The purpose is to effectively mitigate the current debt burden, at the same time have a balanced treatment for the creditor institutions and to mobilize their future further loans to the needy countries. Thank you very much.
Thank you very much, Yikang. That was very useful, and I'm sure there'll be some questions that follow. On your last theme on developing country sovereign debt, we'll be coming back to it, of course, in the second panel of the meeting, we would probably save most of the discussion for that second panel. We move now to Andrew Bailey. Governor Bailey, please.
Well, thank you, Tom.
Just to before Andrew carries on, just to remind everyone in the webinar that you're free to submit your questions now, ideally with both your name and the institution you represent, but please feel free to carry on. Sorry, Andrew, for interrupting you.
Not at all, Tom. Not at all. Thank you, and it's a real pleasure to participate in the G30. I'm going to start with a few very brief comments on where we are today, and then draw out some of the broader issues from that. So obviously we saw an unprecedented fall in activity in the spring, followed by what appeared to be quite a strong recovery as restrictions were lifted over the summer. I wasn't particularly surprised by that pattern, but nor I think should anybody have been carried away by it either. And a number of points really come out of that context. First, just to put it into perspective for the UK, at the end of the third quarter in terms of activity, we think that the level of activity in the economy was around about 10% below where it was at the end of last year. Now, that's better than over 20% below in the late spring, but 10% is still a huge gap. Let's be clear on that. Secondly, the recovery that we saw was highly uneven across sectors and activities. Thirdly, we're operating at an unprecedented level of economic uncertainty. And of course, that is now heightened by the return of COVID. Fourth, the risks remain very heavily skewed towards the downside. So to borrow a phrase from sport, I'm afraid the hard yards, are still to come. So let me now draw out some broader reflections on that pattern. First, it's very hard, I think, to judge the mix of demand and supply shocks at work here, and which channel dominates, if indeed one does. In fact, the answer probably differs across sectors and at different horizons, but as I'll come on to later, it is clearly very relevant. Second, this highly elevated unevenness of recovery has implications for policy. Generally, monetary policy is better suited to aggregate demand shocks. I'll come back to that point later, though. Typically, fiscal policy is better suited to dealing with the cross-sectoral issues. Third, it seems to me reasonable to think that the equilibrium interest rate, R*, will be lower still post-pandemic for some period of time, which is not a short-run cyclical feature. So what does all this mean looking ahead for monetary policy? Well, let me again start off with a rather broad point. I think the last 12 years or so, i.e. from the start of the global financial crisis, have seen much larger shocks than the preceding decade or so. And this has necessitated a search for a more flexible form of inflation targeting. And by that, I mean how to combine the huge benefits of the nominal anchor of the target with the need for more flexibility in putting it into effect in the face of those shocks. I think this is the right way to think about debates such as, is the approach for the future average inflation targeting, or having a point in time target with greater flexibility around the choice of the point in time to return to the target. That's the way at the moment I think about, the debate around those two things. And when you look at where the Federal Reserve is going and where the Bank of England is, because those two things are, a reasonable description. They're actually choices around a theme. They're not radically different, I think. Second, I think we've moved into a world where policymaking involves far more choosing amongst monetary policy tools, rather than a decision on the setting of one tool. That means that what is in the toolbox matters. The effects of these tools can, I think, be much more state contingent. In other words, the transmission of policy and its effects are far more dependent on the state we find ourselves in. And let me give a few illustrations of that across the tools. Let me start with interest rates. I think as we get near to zero and even contemplate going below zero, the effectiveness of policy and its transmission becomes much more conditional. Conditional on the structure and form of the financial system and how it operates and the strength of the financial system, its health, and also conditional on the point in the economic cycle that we find ourselves at. Our assessment of negative rates is, from the experience elsewhere, is that they probably appear to work better in a more wholesale financial market context, and probably better in a nascent upturn. Second, let me turn to quantitative easing. I think we still have the puzzle that Ben Bernanke posed quite a while ago now, is that it appears to work better in practice than in theory. I think part of the answer to that is that it probably is more state contingent than we thought it was in terms of its effects. So if we look at what happened in March, I think across central banks, and certainly for us at the Bank of England, it had a very fast pass-through in what were disorderly markets. The liquidity effect of QE worked very quickly and very powerfully, and that was, of course, vital given the situation we found ourselves in. But it wasn't, I think, enough. We had to look also at what is increasingly, I've noticed, being called Wall Street QE and Main Street QE. Because Wall Street QE is money to markets, if you like, it's liquidity into markets. And it's particularly, as it was in March, about not being able to rely just on what I would call the traditional form of central bank liquidity provision through the banking system, but needing to get to non-bank markets more quickly than we could through the banks. This is a very important area on which the Financial Stability Board is doing very important work at the moment on the whole question of non-bank finance and that experience. Main Street QE is much more, in my view, money to firms, in other words, money to non-financial firms. And we had to go there as well, far more than we ever had before. And that was a big shift in a way, certainly for the Bank of England, but it was a necessary one. And I mentioned earlier, coming back to this point about the relationship between monetary policy and targeted fiscal policy, I think that basic relationship holds. But I think you see in this use of what I might call Main Street QE, those two things starting to come closer together. Third point, on looking forwards, is to come back to this point about unprecedented uncertainty. It's very interesting, I think, anyway, that this condition of unprecedented uncertainty has certainly pushed the optimal monetary policy response to one of aggression, what I describe at Jackson Hole as go big and go fast. It's actually away from the more traditional, use caution in the face of uncertainty until, in a sense, we know more. And it's very interesting when we sit down in the Monetary Policy Committee at the Bank of England and we look at the economy, and then we have in a sense, the view from what I might call the optimal policy analysis view, which takes a more stand back and look at it in that context, that the optimal policy analysis tends to say, go faster and go bigger, and certainly did in the spring. Let me finish just from a point about central banks. I think the experience we've had this year has underlined that the institutional independence of central banks is crucial. I don't think we could have gone big and fast in the way we did to seek to bring rates down across curves and to do so without a risk premium emerging if there was any question about our independence, because I think that would have effectively contradicted it and led to a larger risk premium emerging. So central bank independence is crucial. I think the good news is, from all the evidence I see, and certainly my own experience, that it is holding well. But I hope, I think this illustrates that we face some very big challenges on the policy front going forwards. Thank you.
Sure, Andrew. Thanks very much, Andrew. I'll now open the floor to questions and encourage everyone in the webinar to key in your questions using the Q&A function. I'll start by providing a broad question of my own, and I'll combine it with one of the questions we've just got. Each of our speakers has referred in different ways to the complementarity between monetary and fiscal policies. In the case of China, it was highly coordinated action. But each of you, starting with Christine, all the way to Andrew, have spoken about this issue. And whilst it was very necessary in the crisis forced coordination almost, I think Andrew's concluding remarks suggest that we are now in a whole new phase of much lower inflation or some deflation compared to before, much lower interest rates, possibly negative for some period to come, and much lower growth. And in this context, how do you see the complementarity between fiscal and monetary policy playing out? What's the optimal relationship whilst preserving central bank independence? How do we actually achieve the outcomes we want for the central bank in a way that doesn't just second guess fiscal policy, but has a way of anticipating fiscal policy responses? And the question that we have from Paul Sheard, which I'll read out, is given that R star seems set to be low for long, fiscal policy may be much more important for managing aggregate demand than in the past. If so, do any of the governors see a case for the aggregate demand management component of fiscal policy to be made more independent and technocratic in the same way that monetary policy is? And he's referring to the aggregate demand component of fiscal policy rather than the targeted components of fiscal policy. So that's a very broad question about the relationship between fiscal and monetary policy, and I think it'll be very interesting to get governors' views on this. Who would like to start? Governor Yikang, would you like to say something?
I think that the underlying question is more relevant to countries where interest rate is 0 or close to 0. Whereas, for example, in China, we still have the consideration of what is the potential growth rate, and also what is the our R star. Given our consideration of China's R star and also the potential growth rate, I think at this stage, I do not consider the suggestion of the question. Over to you.
Thanks, Yikang.
Maybe.
Christine, would you like? Yeah, sorry, Governor Kuroda.
Yes. I think the fiscal authorities and the monetary authorities should continue to cooperate. But at the same time, the fiscal authority and the monetary authority or central bank, they have different mandates, and these mandates must be respected continuously. And I think from the central bank point of view, independence of the central bank, its monetary policy making must be respected and continued. As I said, under the current illegal control, kind of fiscal monetary policy mix has been achieved. But at the same time, I emphasize that the monetary policy must be decided by the central bank of Japan, independent from the government. And you may recall that in 2013, the Japanese government and the Bank of Japan issued so-called joint statement in which the central bank, the Bank of Japan, will pursue 2% inflation target with monetary easing, while the fiscal authority would employ fiscal measures flexibly while achieving fiscal soundness in the medium to long run. And each authority has its own mandate, and the mandate must be maintained. I mean, of course, as Andrew emphasized, in the current situation or in the future, closer cooperation between fiscal policy and the monetary policy may be appropriate, but at the same time, I must emphasize that these authorities have different mandates, and the central bank mandate is to achieve price stability and maintain financial stability.
Thanks, Kuroda-san. Andrew, before you answer, I'm going to read out two questions related to this, which have been addressed to you. The first question, Andrew, is from Professor Jeff Frankel at Harvard University. In fact, it can be addressed to anyone, but he refers to the last point you made on central bank independence. And he asks, is separation of responsibilities as important when the goal is to raise expected inflation and hence aggregate demand, as it was 30 years ago when the goal was to reduce inflation? Second question that I would pose to Andrew is from Bill Winters. And Bill asks, does Main Street QE need to be enacted or endorsed by government, or can it be treated similar to market QE and come from an independent central bank? Andrew, over to you.
Yeah, thanks, Tom. Well, let me just on the general point, let me underline that central bank independence is an important public good, and nothing has changed. In fact, if anything, of course, the experience of this year has underlined that. Now, what pleases me and why the remark I made at the end is that I don't detect any questioning of that, and that is vital. I think what we've seen this year is of course a need for strong coordination, and that's not surprising. But none of that should or has, in my view, taken away from the important public good nature of central bank independence. Let me say on the first question, this point about separation of responsibilities in the context of, if you like, getting inflation up to target rather than getting it down to target. I think that's a really interesting question, but my answer is definitely yes. In fact, anything possibly more so, actually. And the reason is I learned this really in the spring, where we had, for a while, quite a lively debate in the UK about what is an old issue, of course, about monetary financing. And were the actions that we were taking of necessity amounting to monetary financing? And I think the reason for that was, in a sense, because in the spring, as we were undertaking a very big quantitative easing program, and the government was undertaking very big fiscal support, and the government's borrowing was going up, these two things looked as if they were happening. happening not just at the same time, which was true, but actually in some degree of greater concert, which was not true. And it revealed to me that there are as many definitions of monetary financing as people who seek to define it. But it also, more importantly, revealed to me the importance of, in a sense, central bank independence in this context, because it clearly did become a more confused at times debate, where we had to lean in quite hard and make the point quite simply that I think in its purest and truest form, monetary financing involves fiscal dominance, and there was no fiscal dominance. That is very clear. But it underlined for me, in response to the question, actually the separation of responsibilities is at least as important in this current context, certainly. On the question, on Bill Winter's question about Main Street QE and independence, well, it is different in a sense, because I can only speak for ourselves now. We do not bear the credit risk on lending to the corporate sector. So for instance, the commercial paper scheme that we introduced in the teeth of the crisis, it's very clear that we have an indemnity for the government to the credit from the government to the credit risk we take. Now, what that means, of course, is that Main Street QE, if you use that term to describe it, is more complicated in that sense, because it has both central bank involvement as a means of providing liquidity and providing more direction on the provision of that liquidity, but it has government involvement in terms of the indemnity and credit risk. So it is a somewhat different animal in that respect.
Thanks very much, Andrew. Christine, before you chip in, if I could read a couple of questions that were directed at you, which are relevant. First, a broad question from Mohammed Al Arian, which I'd ask you to answer if possible. Are there more direct steps that systemically important central banks can take to encourage other policymaking entities to do more to minimize structural damage and encourage structurally sound, long-term inclusive recoveries? So that's an easy one, Christine, which is why I thought you'd like to answer it. Secondly, this is something which you have spoken about several times, from Amar Bhattacharya. You'd spoken about avoiding structural damage, fostering structural change. What are the main opportunities for fostering a green recovery, and what are the implications for policy and finance?
Thank you so much, Tom, and that's a whole bag of questions, actually. What I'd like to maybe start with the first one that was mentioned, and it really rings a bell also here in Europe, because the issue of more and less discretionary fiscal support has been tried in a way and has not always succeeded. The Stability and Growth Pact that was in place has not always been respected including by the key players. And, it's questionable how much discretion you can take out of those decisions. You're actually committing taxpayers' money and to just assign or delegate or subcontract all that selection of choices of both timing and areas of support is I see it as highly political. So I think that's probably going to be difficult. However, they are now in place in most member states of the euro area, some fiscal councils that generally issue public statements that are taken into account and that certainly have a bearing on what policymakers who are more political than technocratical characters will eventually take. In terms of how fiscal and monetary actually link up, operate, cooperate, I think it's the whole difficult delineation between cooperation and compromission. And clearly we have to stay clear of the latter, that could be regarded in proper parlance as the fiscal dominance that we all want to stay clear of. But equally, cooperation, which was a bit of a divine surprise in Europe this time around, has worked extremely well. Just taking a very small example of that, when we provide long-term refinancing operations, the fact that exactly at the same time and with immediate impact, member states put in place guarantee schemes that could encourage banks to actually take up the opportunity of the long-term financing while reducing the risks that are on their balance sheet, has had a very, very strong impact on the volume of credit that was out there in the economy. And I think that in the current circumstances, it also clearly emphasizes the importance of forward guidance. Because in times of massive uncertainty, as Andrew outlined it, the fact that we are providing at least a degree of predictability in the sequence of our actions is offering some predictability. Many would like to see more of it, but clearly this is a lot that we are offering to markets. So in addition to stability, which is our aim, our goal, at least for most of us, the fact that we offer that predictability, I think, is a plus. Now, I want to go to the question about green, essentially, to put it to shortcut it. One thing that has happened in Europe is, which I think is a major change and which will have impact in many areas, is the determination by member states of the whole of the European Union to actually hang together in borrowing and granting portion of that yet to come borrowing to those countries that were most affected. Now that has many dimensions in terms of a new tool, fiscal support that is available, and an element of we're in this together, we're going to get out of this together, which I think is critically important and had been called for quite a while. Now, turning that into the green dimension of it, it is worth noting that 33% of the resilience and recovery plans that member states now have to submit to the European Commission to access this massive volume of grants or borrowing, 33% of their plans have to be directed to green projects, green activity, the greening of existing sectors. And that's clearly a way to both support and encourage. And I was talking in my remarks about the transition, and that's clearly a tool that for the next 3 years or so, which is when the spending will take place, will be morphing from supporting into encouraging the transition that is called for. I'm not sure that I have an answer to Mohammed, who is always asking the tough questions. And all I would say is that by, for to direct long-term refinancing to entities that typically in Europe, at least, do not have access to capital markets, which is notoriously more shallow, less liquid than the US capital market, for instance, is a way to focus on the SMEs and a way to encourage banks to do what they have to do, which is to really provide credit to the economy. Thank you.
Thanks, Christine. Thanks very much. Two final questions, and I must apologize to all the rest who posed questions, some very good questions that we've run out of time. So I'm just going to pose two final questions for any of our panelists to answer. First one from Pierre-Olivier Gorinchas. At the zero lower bound, a key channel of transmission of non-conventional monetary policy is via exchange rates. For instance, in recent months, a major realignment of the euro has occurred. Of course, this raises the prospect of beggar thy neighbor policies and the need for larger central bank coordination. Could the panelists comment on this? So that's Pierre-Olivier's question. I would add Alan Sinai's question. Alan Sinai asks, what is the current state of thinking for each of you on the inflation target of your inflation targeting and forward guidance? Are you changing in the direction of the Federal Reserve? So that's a question on the inflation target. So two important questions. Would anyone like to start? Governor Kuroda, perhaps?
Yes, thank you. On the first question, I must say that even faced with the zero lower bound, central bank has a few tools to affect the economy, not through the exchange rate. For instance, the Bank of Japan has been purchasing long-term government bonds to affect or to almost target long-term interest rate, 10-year JGB rate around 0%. So that the entire yield curve is managed by us, so that the good yield curve would contribute to supporting the economy. Second question is, of course, more complicated, but I can say that the Bank of Japan has yield curve control, and also under the yield curve control, we have also so-called overshooting commitment, by which we mean that we will continue to increase our monetary base until inflation rate reaches 2% and stays there for some time. So the Bank of Japan's policy framework is quite similar to the new framework prescribed by the Federal Reserve. I mean the so-called average inflation targeting, or I should say flexible inflation targeting. So as far as Bank of Japan is concerned, we have no intention to change our inflation targeting policy and forward guidance. Thank you.
Thanks, Kuroda-san. Would anyone like to comment?
Yeah, I'll try to say a few words on for the two questions. Right now, the interest rate differential between 10-year government bond of China and the US is 250 bips. With that interest rate differential, you can see that renminbi exchange rate is appreciating against the US dollar significantly in the past 3 months. I think for the central bank, the monetary policy should focus on domestic demand and domestic inflation targeting, price stability, and let the market decide the exchange rate. In that framework, I think that would maintain stability and also automatic stabilizer for the balance of payments. Over to you.
Very good. Christine or Andrew, would you like to add anything?
I'll just come in, Tom, with just a final comment. I think, just on the inflation target question, I think, as I think I said in my remarks, I think the much more important question is around what I call flexibility in achieving a target and how a target is achieved rather than changing the target. I don't think changing the target is the right way to think about it. But I think it is appropriate that many of us are thinking about the question of how we achieve the target in a world of much bigger shocks. On exchange rates, I would just draw the distinction between targeting an exchange rate and the consequences for an exchange rate of monetary policy. It isn't actually a matter of sort of, splitting hairs. It's a very important thing. I don't think I can certainly say, targeting exchange rates just doesn't come up in our discussions. Certainly, I don't think we're unrepresented. I think what is interesting, and I think this is an open economy point, I think, that if you look at the last decade and you look at average performance of inflation versus targets, it probably certainly does look a bit different for more open economies than less open economies, because exchange rates are a larger channel in monetary policy. I certainly think one of the reasons that average inflation in the UK actually isn't below target in the period since the financial crisis, it's only one part of it is probably the operation of the exchange rate.
Thanks, Andrew. Christine, you have the last minute. You're muted.
Thank you, Tom.
Yep.
Thank you, Tom. I would simply, on the exchange rate, totally endorse the comment that was just made by Andrew. I would say same here. And in relation to the inflation target of our inflation targeting, I would also mention that we are right now in the process of conducting an independent strategy review, and that strategy review is going to continue and will deliver results later on in early 2021. So I'm not going to prejudge, but it's totally independent and will be conducted in full autonomy. Thank you.
Thanks, Christine. Well, thanks very much to all four governors for your very thoughtful remarks in this session. Thank you very much. And we will now close the first panel and move on to the second panel of the International Banking Seminar. The second panel is on the topic of the emerging world. Right. We move now to the second panel. In case I wasn't heard, I was thanking the speakers on the first panel for your very thoughtful remarks. Thank you very much. And we move now to the second panel, which is on the emerging world, achieving recovery with debt sustainability. Again, a very important issue and important for a few reasons. First, I think no one can reasonably assume that the effects of the pandemic on the developing world are anywhere near reaching an end. We are still at an early stage of this crisis, and it's going to be a long haul. No one can reasonably assume that we face only liquidity problems as opposed to solvency problems. And importantly, too, the whole issue of sovereign debt restructuring comes into play when we think about how we are going to achieve net new financing, how we are going to achieve the much larger scale of financing that we need in order to rebuild growth over the medium term and the longer term. So it's a complex issue, but an extremely important one. I'm joined, for those of you who didn't come in earlier, those in the webinar who didn't come in earlier, I'm joined by my co-chair, Jacob Frenkel, who will be giving concluding remarks later on. But we have four speakers who are each deeply involved in the issue of emerging market sovereign debt, to thinking through the issue of emerging market sovereign debt restructuring. Kristalina Georgieva, Managing Director of the IMF, who has called for a new international debt architecture to enable orderly sovereign debt restructurings, and has been speaking very prominently on this topic. Lawrence Summers, professor at Harvard University, well known to all of us, who's also one of the co-chairs, together with Guillermo Ortiz, of an ongoing Group of 30 report on the same subject of sovereign debt and the restructuring that's required for recovery. Larry, together with Guillermo, released the initial recommendations of that report earlier this week. Third, we've got Ken Ofori-Atta, who's both Minister of Finance for Ghana, as well as Chairman of the Development Committee of the World Bank. And fourth, we've got Alejandro Diaz de Leon, Governor of the Bank of Mexico. And we will I'll be inviting each of them to speak in the order that I just introduced them. So over to you, Kristalina.
Thank you very much, Tarman. Thank you for inviting me to take part in the seminar. I was listening with great interest the previous speakers, we are clearly at the time when we do need to come together and see a way through what is by far the worst crisis we have experienced since the Second World War. The topic is achieving recovery with debt sustainability. So let me first say a couple of words about the recovery. As we heard in the previous panel, the picture over the last months has become less dire as activity began to improve. And it is on two legs. One is the very strong and synchronized monetary policy and fiscal support that has been put in place. And the other one is we have measures that help us to function with the pandemic still with us. In some countries done much better than in others. So one of the obvious conclusions here is please learn from those who have done better than you. And when we say less dire, I want to put the emphasis on dire nonetheless. We continue to project the worst global recession since the Great Depression, growth falling by minus 4.4%, falling minus 4.4%, partial and uneven recovery in 21, growth at 5.2%. For emerging markets and developing countries, with few exceptions, China and a small number of countries, mostly in East Asia, all badly hit. Growth in 2020 is expected to be, for this group of countries, minus 3.3%. Let's remember, they were the countries that carried us up with very significant growth rates. There are big variations from across countries. And recovery is expected to be at 6% 2021, not enough to assure a return to the pre-COVID levels. And as you said in the beginning, we are faced with a long ascent. The journey is going to be difficult, uneven, uncertain, prone to setbacks. And faced with this situation, obviously we have to concentrate on clear focus on the major challenges, and we have discussed those in the last days. So the first one is to restore confidence. To restore confidence, we have to get to a point when we have vaccines. To restore full confidence, we have to have vaccines and treatment available everywhere. Vaccine policy is becoming a core of economic policy. And I think we all would agree that international cooperation here is paramount. Second, we have to avoid premature withdrawal of policy support. We saw people talked about the extraordinary measures taken. I'm not going to repeat it. What we know is that until we see the health crisis in the rearview mirror, this exceptional support needs to be there to keep lifelines, to make sure that the recovery is sustained. In other words, yes, in medium term, we have to balance the books. Yes, not yet the time to do it. Whereas it is now the time to think how to gradually shift from broad income and firm support to more targeted support. And we have heard the role smart policies in investing in digital innovation and in green recovery can both create jobs in the near term and ensure that we have sustainability in the long term. And third, and now I'm getting to the issue of that, we have to deal with pre-existing conditions. The same way people with pre-existing conditions get hammered by the virus, economies with pre-existing conditions have really hard time to stand up to the economic crisis. Countries with strong fundamentals clearly weather the crisis better. I don't know whether Christine is still on the call, but Christine was so clear for so many years saying the sun is shining, fix the roof. In other words, do the policies to make your economy stronger. Well, now rain is pouring, and those with leaky roofs, they have no choice. They have to get up there and fix this roof. And that applies very much to heavy pre-COVID debt levels. And I'm so grateful that the group of 30 focused on this issue and came up with a very substantive and constructive set of recommendations. Among the countries with high debt level, low-income countries are particularly vulnerable. Over 50% of them are either at debt distress or high risk prior to we got into this crisis, and their situation, of course, worsened. We project global debt levels to reach 100% of GDP next year. Higher spending, lower revenues. Nothing else would come out of it but higher debt levels. What it means is that between 2019 and 2021, debt ratios will go up by 20% of GDP in advanced economies, 125% of GDP, 12% of GDP in emerging market economies, up to about 65, 68% of GDP, and 7% up in low-income countries to about 50% of GDP. And you may say, well, but low-income countries are less under debt. Well, they also have much less debt carrying capacity. And therefore, we absolutely must zero on debt distress in low-income countries, emerging markets, and low-income economies. So what we have to recognize is that policy action by advanced economies have helped. They have positive spillover impact. Emerging markets with good fundamentals can borrow at very low cost. And the extension of swap lines by many of the advanced economies to emerging markets definitely helped. We also did our part. As you know, we have provided over $100 billion in financial support to the membership. 81 countries tapped into the fund. And we also got the breath of fresh air through the debt service suspension initiative. It has been extended. Great. We are very, very grateful of it. But let's be clear, this is helping some, not resolving the problem. So we are buying some time, but we have to face reality. There are much more decisive actions ahead of us. So what do we need to do? First, where debt is unsustainable, it should be restructured without the delay. Doing too little, too late is costly to debtors, costly also to creditors. We get in disorderly default, and we know how quickly it is spreading negative impact around beyond the countries that are affected. And if we make that relief conditional to a fund program, that can insensitize countries to tackle debt sustainability early, because then they would know they have the buffer coming from the fund. To facilitate orderly debt restructurings, the international debt architecture needs to reform. And you mentioned that, Tarman. Our new report shows that the existing contractual framework has been largely effective to restructure sovereign bonds. But we still have problems. It is less effective for restructuring the non-bonded debt, as well as for restructuring collateralized debt, and that collateralized debt has gone up. So what are the fixings that I would be very interested to hear feedback and advice from the discussion. First, debtors and creditors should continue to strengthen contractual provisions to help minimize economic disruptions when debtors run into trouble. For instance, clauses that lower debt payments or automatically suspend debt service in the event of a shock, they can be very helpful. Second, debt transparency. Without transparency, creditors cannot make informed lending decisions. It exacerbates sustainability fears, makes lenders to stay on the sideline, credit dries up, and the restructurings are harder. Third, official bilateral creditors should agree on a common approach. And I'm very encouraged by the common framework for debt treatments beyond the DSSI that was agreed in principle by the G20. I cannot stress enough how important it is to bring this work to a higher denominator conclusion, not to the lowest possible denominator that sometimes we are tempted to stop with. And beyond that, I want to finish by saying the obvious. IFIs, the fund, multilateral development banks, the World Bank, we have to continue to lean forward in this crisis to provide strong support to low-income countries and to emerging markets that are particularly hard hit, either because their economies are tourism dependent on sectors that are suffering a lot, or because they do have these preconditions. We basically, my message here is simple: put our money where our mouth is. We are recommending to avoid premature withdrawal of support. We have to be part of the solution in making sure this advice is followed. And we also have to do it with a clear compact. Countries do the right thing in domestic policies, domestic resource mobilization, high quality of spending. We are there for them. In other words, fix the roof. Thank you very much, Tarman, and I very much look forward to the discussion today.
Thanks very much, Kristalina. That was a very clear and forceful message. Before we move on to Larry, I'll just remind everyone in the webinar that you're free to enter questions at any point. Just use the Q&A function that's either at the bottom or the top of your screen, and identify yourself in the questions. So we move now to Larry.
Thank you very much, Tharman. It's a privilege to be here. I am the only speaker who is unburdened by official responsibility, and I will take advantage of that to not wear a tie and to be provocative as well. I speak only for myself. Let me make three broad observations to begin, and then talk about the recommendations of the G30 report, and then offer a concluding word. First observation: more than ever before, the fate of the global system depends on what happens in emerging markets. In a geopolitical sense, that is all but self-evident. In a contagion and humanitarian sense, that is obvious. If one says the word refugee flows and imagines all that comes, that is clear. It is also the case at a moment when saving absorption will be a dominant problem for the global economy going forward, as manifest in neutral real interest rates, which despite massive deficits are now negative throughout the industrial world, that the world cannot afford a resurgence of capital flows or debt repayments from the developing world to the industrial world. Instead, what is necessary is a substantial architecture that will permit the appropriate north-south flow of capital payments. That architecture, I do not believe, is currently in place. Second observation: financial history reveals dozens of cases in which debt problems were dealt with too late, in which, with the benefit of hindsight, we can see that the can was kicked forward and kicked forward and kicked forward. Debt overhangs remained, healthy reformist governments were undermined, people suffered, and the problem was dealt with for both borrowers and creditors alike in ways were much more painful than would have been necessary. I am aware of no cases in which history judges debt relief to have been accorded prematurely, or looks back and says, gosh, if only we had not provided debt relief, things would have been much better. True, in some cases, assistance has been provided to countries, either through debt relief or in other ways, with insufficient conditionality. There is no suggestion that the lack of policy commitment is the reason for inadequacy of current debt restructuring efforts. You just witnessed a diplomatic, if remarkable, thing, or maybe I should say remarkable, if diplomatic thing. The managing director of the IMF just acknowledged what is obvious for all to see, which is that DSSI is a squirt gun meeting a massive conflagration. And the fact that the squirt gun is going to be with us for 6 more months can only be limited solace. Third observation: the conspicuous feature of the global response to this crisis, in contrast to the 2008 financial crisis, is that the domestic responses in all the major countries have been far broader, far more sweeping, and far more aggressive, as measured by fiscal expansion, as measured by expansion of central bank balance sheet, as measured by innovation in tactics for promoting credit. And yet, the global response has been a very small fraction of the actions proposed and advanced at the London summit in 2009. No SDRs, no shared joint commitments to resisting protection, no massive replenishments of the global financial institutions, no substantial stepping up of the level of lending. And so we are at a critical moment. History teaches us that it might be that, well, I may say it differently. History teaches us that there are countless errors of being too late for every error of being too early, and we are doing next to nothing internationally. And to use something I've said in the US context, I would suggest it is possible that the current improvement in conditions, that the relative flow of credit markets will continue. That is not a possibility to be precluded. But to have that as your strategy is like having the strategy of plunging into crowds during COVID without wearing a mask. That it could conceivably work does not make it other than entirely imprudent and foolhardy. What then should be done? Our report, I'm going to put it in some of my own languages, identifies an agenda with 7 parts. First, strengthen the response coming from the IMF. Critically, there should be an increase in SDRs, probably best done in the form of 2 $500 billion tranches to reduce need for legislative approvals, coupled with reallocation to target more effectively. In addition, through some combination of government contribution and appropriate financial engineering at the IMF, I would argue not to exclude the use of gold resources, the mobilization of gold resources, IMF concessional and non-concessional lending should be substantially enhanced to enable governments to provide their COVID function. this is a moment for external lending without critical financial emergency. Second, the development banks need to take parallel steps. We are putting the finances of large numbers of people and the health of large numbers of people at a time when 100 million more people in the world are in poverty at risk in order to have the last scintilla of balance sheet security in the World Bank and some of the other regional development banks. There is no reason why, in the face of this emergency, given the commitment of the world governments to stand behind them, they cannot substantially increase their lending levels. This is a once every decade or two moment when the constraint on moving funds is not lack of need or lack of suitable policy and ability to use the funds well. It is the obligation of the fortunate to step up to meet the need for resources that can be used well, especially in Latin America and in Africa, where the prospect of a lost decade of per capita growth, given what has already happened between 2015 and 2020, now looks very likely. Third and fourth, and I will connect these points, and I will speak frankly. Credible debt reduction requires universal participation and the perception of universal participation. Creditors are, in many cases, willing to take their responsibility, but not for the benefit of other creditors to take their money out. Whether it is through new money or whether it is through accepting debt reduction or whether it is through accepting protracted restructuring. It is necessary that we have architectures that assure universality of participation. The principle of comparable treatment of all creditors is far more important than any principle about which category, which institution belongs in, which international forum is the forum. I have long opposed proposals to formalize international bankruptcy courts or the like, because I have believed that they are unwieldy, will have a whole set of perverse effects. But if it continues to be the case that large amounts are lent at spreads that suggest substantial probabilities of non-full payment of debts, if that continues to be the case and no more voluntary and cooperative architecture is found in order to deal more satisfactorily with these problems, the question of much heavier-handed tools will not fail to be raised. I would say to my friends in the private sector that you are right to emphasize the importance and desirability of voluntary access to and successful access to credit markets and not wanting to see it compromised. But you are badly wrong when you hold out that prospect as a reason for not restructuring debt in contexts where it is not a realistic or an imminent prospect. I speak in these regards both to new official creditors on the international stage, including especially that represented so ably by my good friend Yi Gang, China, and I speak especially to private sector participants in this seminar. More briefly, Kristalina is right in her emphasis on contractual terms that will in various ways both permit restructuring and facilitate restructuring, and also facilitate an element of contingency so that risks of subsequent events are borne by lenders, not by individual countries. This is probably particularly important for the lowest income countries. I also applaud her emphasis on transparency. And I believe, as the G30 report suggests, there needs to be more doubt about the legal enforcement of debts that are not made transparent and authorized in the major financial centers. Finally, and our report, in all honesty, does a better job of pointing up this issue than it does pointing towards its resolution. There is a substantial concern on the part of many who should benefit from debt relief that the effort to take advantage of much needed debt relief will result in ratings downgrades that will in turn compromise access in both public and private sector. We are convinced that this is a serious issue and has been an important contributor to the DSSI not reaching even the extent of its very limited potential. And we believe that as we move to our final report, this is something we will give much thought to, but we believe much more broadly the global financial community needs to give it much more thought. A final hope. I believe that new winds are blowing after a very difficult year. It is my fairly confident but not certain expectation that they will blow with gale force in early November in my country. My hope is that within the first 100 days of a new presidency, a G20 convening of world leaders will take place with the objective of forming a global compact for economic and health renewal that will assure a new energy in the global anti-COVID effort, will draw on the common threat and the energy that the common threat of COVID provides to all of humanity to foster a new era of cooperation, and that will provide the necessary high political impetus when these subjects are discussed in the context of these meetings next spring. These are solvable problems. Let us hope that they will be solved.
Thanks very much, Larry, and thanks especially for taking full advantage of the fact that you're not wearing a tie. We move now to my good friend Ken Ofori-Atta.
Yeah.
And Ken, you feel free to take your mask off if you think it'll be clearer, but
Great.
I leave that to you.
Thank you so much, Tharman, and I think maybe that's part of Africa's resilience. We do obey wearing the mask. Thank you very much, and thank you, Larry. Thank you, Kristalina. This is truly wonderful. I'm really sort of short of words because, you know, we have always believed that we have the tools, we have the minds, and we have the capital to do what Larry is saying. We just don't seem to have found ourselves in a good place to put the people together to tackle this problem, which is really creating, you know, untold hardship in Africa. We have somehow been spurred, I don't know, through resilience or something, from a devastating health impact immediately on human lives. But the economic impact just egregious, and I think we all see it. We saw a couple weeks ago, maybe 3 weeks ago, Zambia coming out, which had been predicted anyway, that a lot of us are going to have defaults if we don't tackle that. And I was reading MacArthur's speech to Harvard, talking about Europe and saying that we can't do this piecemeal. It just won't work. It will be costly, it will be painful, and it will be unnecessary because we have the resources to do that. So yes, for us on the continent, I think we have put some proposals out of about 300 billion also to have a liquidity facility in which there will be credit enhancement so that we can also borrow as cheaply as our emerging market friends and the developed world is borrowing. And the fact of the matter, Therma, is that enlightened self-interest should really encourage us to do this quickly. Because if truly Africa is going to be a quarter of the world's population by 2050, and most of the youth, we can't afford not to accelerate this recovery because we will then be the people who will be ensuring that global supply chains are merited and diversified, and that the consumption ability will continue because you have a prosperous Africa in many ways. I mean, I think it's been, let's say for Ghana, for example, moved from a 6.8% growth to 0.9%, which was kind of positive. We've just revised it to 1.9%. But then we have used all of our toolkit. How much more can one borrow from the central bank? How much more can you push the banks to also support the private sector? And then you face a downgrade from the rating agencies. And then you also face potential blacklisting for the way in which monies are transferred. So you see Africa really sort of pinned to the wall for a continent that the past 20 years has been making incredible progress in growth. And as Kristalina said, at some point, these growth rates from emerging markets and ours was what then kept, you know, the West going. And we are at this point where we talk about 300 billion, which is less than 2.5% of the 12 trillion that has been pumped in. And you really feel like you have been suffocated. And for no good reason, because you know the resources are available. I had talked one time about a triangulation given what we're experiencing, and that triangulation really meaning the US, China, and the private sector, and exactly how to come to a compact for us to resolve this. You know, certainly the issue of making sure that there's fairness in the way in which this is structured, as Larry mentioned, is important. And for me, for the US to be able to come through with the SDRs must also mean that both China and the private sector are participating fully in the restructuring that we require. I mean, China is a very important player on the continent, about 160 billion, and clearly there could be literally their own DSSI, which will eliminate this sense of taking money from the West and to pay them off. And it's also very much in the ambit of the private creditors to really look at the inevitability of defaults coming next year and say, let's sit down and let's restructure. So there's a window in which we all can win. And yes, we have called for a secretariat of some sort, and Larry calls it a global compact, that we can sit really. I think there's enough time before the spring meetings for us to be able to sit to restructure, to debt forgive, and ensure that we recalibrate where we are going. I think it's an incredible opportunity for us to create a new sense of humanity and understanding of what the future portends, where populations are, and how best to increase global prosperity and peace. And I hope that we will get the men and women to actually sit down to get this done. But I am deeply confident that our humanity will come to bear and we'll find solutions to this before the next spring meetings. Thank you very much.
Thanks very much, Ken, for those very thoughtful remarks. Thank you very much. We move now to Governor Alejandro.
Thank you very much, Tharman, for the opportunity. It's an honor to be in this G30 banking seminar. Let me start saying that clearly the COVID-19 pandemic has imposed most grave human and economic costs to our countries. Mexico has over 840,000 confirmed cases of contagion and unfortunately more than 85,000 deceased. So one of the countries with high unfortunate numbers. We have faced three shocks: a supply side, demand side, and a financial shock. In the first phase of the shock, we faced a sharp increase in risk aversion and in global financial markets with strong effects on emerging markets. We faced significant capital outflows and exchange rate and a risk premium adjustments, and also widespread credit downgrades that obviously work procyclically. In contrast with the 2008 and 2009 great financial crisis that had its epicenter in advanced economies and emerging markets mainly suffered its side effects, in contrast, the pandemic has significantly affected all countries, and its effects have been more dire in economies with less mature institutions, which implies an acute challenge for low and middle income countries. What was expected to be a transitory shock has become longer lasting. The difficulties in containing the pandemic point to a shock that has been more persistent and with more profound economic effects. These crises will have significant heterogeneous effects between countries and within specific economic sectors and groups in society. This has had significant consequences in the informal sector and face-to-face services that are very important for emerging markets. The pandemic has also accelerated ongoing trends that imply worrisome challenges, in particular, a technological divide among individuals and firms, and more inequality in education and development opportunities. And I think this is a challenge very acute for emerging markets. In terms of crisis response, advanced economies have implemented significant stimulus through large-scale support packages and accommodative monetary and fiscal policies. This has been important to break the risk aversion vicious circle that we saw in global financial markets and to support the recovery worldwide. In emerging markets, the main challenge is to support the economic recovery, but without compromising macro and financial stability. As the negative shock becomes more persistent, the situation also becomes more challenging. In general, emerging markets are capital import economies that need to be mindful of maintaining adequate sources of finance. Thus, we also need to be mindful of the policy space available. And in this regard, let me use the IMF surveillance consideration for emerging markets about debt sustainability to GDP levels. Below the 50% to debt to GDP levels is the low surveillance zone. Between 50 to 70% is a more in-depth surveillance area, and above 70%, that is the high-risk zone where debt sustainability could be compromised. And clearly, all emerging markets, we are having pressure to increase our debt to GDP levels. Also, credit ratings, as has been noted, warnings and assessments are influencing financing opportunity and market access. Sudden changes in a country's debt sustainability outlook or in risk appetite, either associated by global or idiosyncratic factors, or how those global shocks can affect our resilience in domestic countries, can trigger a rapid shift in investors' portfolios. Emerging markets highly integrated to global financial markets can experience a larger portfolio adjustment. So we need to be mindful of the policy space, but that doesn't mean or justify inaction. What we need to do is to increase that space with sound medium-term reforms. And in order, I think we need to implement a comprehensive package of near-term support, credible medium-term strategies to anchor fiscal sustainability, and pro-growth and investor-friendly structural reforms are also much needed. Credible medium-term fiscal reform would increase policy space in the near term, reduce risk premia, and generate needed resources for public investment and social spending. In terms of monetary support and the challenges we face regarding our balance sheet management, let me say the following. Central banks in emerging markets have also tried to relax as much as we can monetary policy stances with interest rates at historically low levels. Nonetheless, there is a sharp contrast between advanced economies and emerging markets, since the average level of the yield curve remains high in emerging markets. This reflects that long-term yields have remained high as a result of higher risk premium. Credit default swaps remain significantly higher when compared to the pre-COVID levels, and resilient macro mix will allow for a lower risk premium too. So global risk aversion and domestic financial markets volatility require a broad set of measures to foster liquidity and support the credit channel. That's why, for example, Bank of Mexico announced several facilities to provide liquidity of up to 3.3 percentage points of GDP, increasing our balance sheet. We basically, and there is here a debate, is every expansion of balance sheet QE? And we believe that there are two different types of balance sheet management. The first one is supplying liquidity to banks and financial markets at times of acute risk aversion. This type of support has been a part of central bank's role for a very long time. In this case, central bank actions, including in emerging markets, seek to avoid a credit crunch and avert a bank or financial market panic. Second, in terms of unconventional monetary policies, this is usually, and QE here, it's usually in a different type of context, when inflation and their medium and long-term expectations are persistently below their inflation targets, when there is a prolonged weak economic outlook, and the policy rate has reached the effective lower bound. So in this regard, asset purchases that seek to expand the monetary policy toolkit and its effectiveness. And the main unconventional asset purchases program in advanced economies acquires medium and long-term government securities to reduce the medium and long-term parts of the yield curve, or this indirect yield curve management. The objective of this strategy is to support expenditures and aggregate demand. But for countries with high debt to GDP levels, these asset purchase programs can introduce the debate about central bank financing to governments that was mentioned in the first panel. And this type of support should not give rise or increase the perception of a situation of fiscal dominance. In Mexico, what we have done is to provide liquidity to foster a sound development of the financial system and not as a part of a QE strategy. Finally, I would like to conclude with some thoughts about the role of the international financial institutions. First, if IFIs serve their membership better, I think by flexible and in deployment of existing instruments and by adapting swiftly to changing circumstances, including by creating new instruments and new approaches. And I support Managing Director Georgieva's message about considering options to further adapt the IMF lending toolkit, including by helping members respond to uncertainties brought by the pandemic. Unprecedented shocks call for unprecedented responses. Second, I would like to recall one of the 2018 Eminent Person Group's recommendation to strengthen global financial governance. Recommendation 4 called for the reduction and diversifying risk on a system-wide basis to mobilize significantly greater private investment, including portfolio-based infrastructure financing. It is clear that when a global shock hits, affecting a wide range of countries, capital needs to be mobilized quickly and affordably, while diversifying risk. The IFIs can play a critical role in this regard, launching more ambitious, for example, loan guarantees programs with a broad-based, well-diversified portfolio that could minimize expected losses. These would allow countries to timely access emergency financing through international capital markets and the specific expenditure items like pandemic emergency responses. This forward-looking approach complements the debt suspension and debt restructuring approaches initiatives that have been deployed and that can serve middle-income countries as well as low-income countries. In sum, a multilateral and cooperative approach is essential for the world to face these and future crises. We must use the lessons learned in this episode to strengthen the institutional design of the international financial institutions and to ensure that they have the instruments and sufficient resources to help member countries navigate through uncharted territory. Thank you. Thank you, Chairman.
Thanks very much, Alejandro. That was very useful, very comprehensive and useful. Thank you. So we now move on to questions, and a reminder to all our participants in the webinar to key in your questions using the question and answer function. We already have a few questions, and I will take a few at the same time and leave it to panelists as to which ones you want to answer. First, a question from the former governor of the Central Bank of Barbados, Delal Worrell. Some of you would know Governor Worrell. And the question is, surely the main driver of international capital flows is profitable investment opportunities, of which there are many in infrastructure and the green economy. Why then is there such a focus on the DSSI, which is a mere squirt gun? Next, two related questions from Jean-Luc Alexandre from University Paris Dauphine. First, what is your view on the potential mandatory participation of the private sector to DSSI? And this was directed especially at Governor Alejandro. What is your view on the potential mandatory participation of the private sector to DSSI? A related question which Jean-Luc Alexandre posed is, how do we define the list of countries for which the participation of the private sector in DSSI should be mandatory? Because it's not the case that every country needs debt reduction. And although the question was posed in terms of the DSSI, given that it's a squirt gun, I would say we should also interpret the question more broadly between encouraging, incentivizing, and making mandatory private sector participation. What's our thinking on debt restructuring coordination? And then a question for Larry as the only non-official on the panel from Luigi Zingales. Where do you draw the line for debt restructuring? Is Italy above or below that line? So I'll stop at that set of questions, and we can take, we can go with anyone who wants to start off. Kristalina, would you like to start since you're speaking with the authority here?
Certainly, and I would take the first question that you posed to us. I agree that the debt service suspension initiative is an element, not necessarily the largest one. in addressing the problems faced by, in particular, low-income countries. I mean, the DSSI is for low-income countries. The issue of debt is bigger than the low-income countries to begin with. And this is why in my comments, I stress that we ought to think of how developing economies can themselves take actions to improve their performance and be sufficiently supported by additional financing, including from the international financial institutions, of course, including from the IMF. I could not agree more with comments that have been made that to get through this crisis, we have to think of what kind of economy we would have on the other side that is desirable and likely to be on the other side, and how we make sure that countries orient themselves to support the economy of tomorrow, not the economy of yesterday. And for that purpose, at the IMF, we take very seriously our role in policy engagement and program support to be helping countries make this turn. Clearly, we need more resilient economies. Climate change is another shock that is already experienced by many, will be certainly there for all of us. To get to that resilience, we see three types of actions. One, resilient people. When we have people that are educated, skilled, able to shift from one type of employment to another, that are able to function in the knowledge economy, then of course we are more resilient. When they're healthy, when we are healthy, when there is social protection, so if something bad happens, we don't see collapse of household demand. All of this is very important, and we want to see policies oriented towards resilient people. Secondly, we need resilient infrastructure. And that means for in advanced economies, plenty of space to do just to rehabilitate the infrastructure and to complete the building of the digital infrastructure. In emerging markets, plenty to do in that regard, and make it low carbon, make the economy low carbon, climate resilient. It has to go that way. And then of course we need resilient finances. And this is not new. Build buffers in good days, make sure that you deploy them appropriately, and make sure that we collectively watch over financial stability. And of course, I recognize the role the IMF ought to play. We are in uncharted territories. What it means is also that we have to be brave and do not just what we know how to do from the past, but think about what is appropriate to do for the future. Brave doesn't mean not prudent. Brave and prudent can go hand in hand. And I for one, many of the things that were said before me, the other panelists, I would subscribe to in what it means to lean forward in uncertainty in this crisis. So let me just say that if we don't think as collective action being the most effective action, we are not going to be in a very good place down the road.
Thanks, Kristalina. Thanks very much. Governor Alejandro, would you like to respond to that question?
Well, just very quickly, clearly here, the challenge is how do we go from a bad equilibrium towards a good equilibrium, and with this braveness and boldness and prudence that Kristalina mentioned. And I think we need to ensure this universal participation that Larry talked about. And mandatory participation, it is always complicated. How do you move towards universal participation? And for example, Mexico has twice changed the contracts of external debt to basically, let's say, the CACs, the generation 1 of CACs, and 2015 second generation CACs, basically to minimize the probability of holdouts and having the possibility of bundling adjacent tiers in a restructuring. And it is a very complex issue how to ensure that you can push towards universal participation. And there are time consistency issues and challenges there. But clearly, as Larry mentioned, it is a goal to have universal participation for this to work out for the better and really reach a better equilibrium.
Thanks, Alejandro. Larry?
No, Luigi, I would not favor Italian debt restructuring right now for 100 good reasons. In general, all the questions about drawing the precise line, I don't know the precise answer, but it's pretty clear to me that I should lose weight, and it's pretty clear that I should lose a fair amount of weight, and just how much is the right amount is an interesting issue, but it's not the issue for this moment. With respect to, and that's how I feel about moving forward on debt reduction. With respect to voluntary participation, I promise, I do know and understand all the various arguments about compulsion. What I would just say to my friends in the private sector is when you are enabled to lend money at spreads 3, 4, 5, 6% above free market, above U.S. Treasury rates, that is because the market is pricing a substantial risk of default or of the need for restructuring. Under those circumstances, you can't act as if it is the end of the world. I'll say what I have been saying literally now for 30 years about the global capital market to no effect. I think there are two ways a capital market can function reasonably and one way it can't. One way it can function reasonably is like the US bond market works. There are lots of bonds with high spreads. Things happen, things that are completely unexpected happen, and they get restructured. Life goes on, and it's very exciting for the people who are involved, but nobody else much notices. And so high yields are a part of life, and restructuring is a part of life. That's one way a viable capital market can function. A second way a viable capital market can function is the way, with a few exceptions, the US 48 states, state and municipal bond market functions. Spreads are 30 basis points, 50 basis points, 80 basis points. People who buy the instruments assume they're going to get paid. Defaults are rare. And when there's the prospect of a default, it's a pretty dramatic event, but it happens only very infrequently. That's another way the capital market can function. The way the capital market can't function or can't healthily function is with spreads that suggest that defaults will be recurrent events, but market realities that don't provide for those events to take place in an orderly way. And we need to push the emerging market system in one or the other of those two ways. But it is absurd for countries to be borrowing at 600 basis points and people to be seeing it as the job of taxpayers around the world through the IMF to enable the rolling over of those debts when they can't roll it over themselves. So that's the fundamental question of the architecture, going beyond how we deal with the current debt overhang. And I have to say, I don't think the world has made much progress.
That's a very good point, Larry. That's a very useful point. Ken, would you like to chip in on this issue as well?
See? Great. Thank you very much. Thank you indeed. I'd love to. I just stepped out of a cabinet retreat, so I'll need to be going back myself. But truly, Tharman, I think one of the issues that Africa has been crying out about is this whole 600 to 800 basis points premium that we tend to pay for the things we do, including insurance. And if you look at the history of defaults, you just do not see how that pricing comes about, except that we are squeezed into a certain corner and category, which that leads to. And then the whole issue of rating agencies, which was meant to bring some transparency and equanimity in what we do, has suddenly become a sort of Damocles, where you don't quite understand what goes into that toolbox, and they can degrade you to make market access, less than. I mean, when we look at maybe close to $100 trillion under management, subpar performance, zero performance, etc., and then you see the need for infrastructure financing, which will go to create better global prosperity and therefore maybe even reduce the perceived risk. And that is where this new eclixir for a new foundation for the financial architecture is necessary, for us to come out in a way in which we define the capital markets maybe differently, but still have price discovery and appreciate really the new risk that are there, so that the velocity of money would occur and money will be deployed in appropriate places for a better world. I think truly, trying to slice and dice and answer the questions with precise lines, it's not where we are at. We are at a point similar to the Great Depression, in which really big decisions need to be made, and we will work out the nuances later. But we should be in a hurry to do this to avert a global disaster. Thank you.
Thanks, Ken. Final set of questions, and they are related, and they broadly refer to what it takes to mobilize political support, particularly in the developed world, for the type of cooperative solutions that we are talking about. One question was, a broad question from Paul Sheard. What's the best way to get developed world electorates to buy into developing world debt relief? Assuming we don't have what Larry spoke about, which is the sense of obligation, but how do you get that sense of mutual interest? A related question from Andre Velasco. The current international strategy regarding emergency capital flows to emerging markets and developing countries amounts to walking through a crowd without a mask, as Larry put it. In the middle of a pandemic, it may work, but it probably will not. Given that, it would be good to hear from IMF MD, Kristalina, what else can be done in the current political environment? And Andre then asked a question which you need an answer, which is, or is new political leadership in the US what we need before we can move forward? And there's a related question which came in earlier, and this came from Andy Green from the Center for American Progress in Washington. And I will take the liberty of focusing and reformulating slightly the question so it's part of the flow of the discussion. Does it not make sense for authorities to recognize how important labor market outcomes are, in particular collective bargaining rights, as well as policies to counter corporate concentration? How important they are to securing reliable economic growth and financial stability. So it's a set of related questions, and I put it to any of you. Kristalina?
Thank you, Tharman. We are in a tight spot in time, so I'll try to be as short as possible. to get the people in developed countries to understand why debt relief in some developing countries is necessary. In my experience, the best way to translate that is a moral issue, and many people embrace it as such, but it is also enlightened self-interest, primarily from the perspective of security and migration that follows when security is gone. And I think we have to lift up our voices, all of us, on the fact that after decades of poverty going down, today it is going up. Why did we want poverty to go down? Because we want a prosperous and secure future. So we have to be very, very strong in showing the consequences of not arresting this very dangerous trend of poverty going up for everyone. On what more can be done at the fund, we think about the answer to this question day and night. What we want to do more, and we got some mandate from our membership to do more. One, increase concessional lending. Absolutely paramount. And what we are doing is actually what the report that the G30 has produced says we should be doing. Shift more SDRs from countries that have it but don't use it to countries that need it. And on this call so far, we got $21 billion. This is more than we asked for. We will pursue to do more. We also want to continue to engage with the membership on, do we have the right instruments for this crisis? We have created short-term liquidity line, has not been used yet. Doesn't mean that it may not be necessary. And it doesn't mean that we may not need to look at it and say, did we calibrate this short-term liquidity line the right way? We are also looking at what kind of maturities and what kind of conditionalities there should be in programs that are there to help countries restructure, redirect their economies towards green, more resilient digital future. So these are some of these are activities underway. And I want to let everybody know that we take our responsibility to heart, and we want to see the membership together acting decisively in this crisis.
Thanks very much, Kristalina. Larry?
Let me make 2 points in closing. First on politics and then on economics. On politics, this is forward defense of US interests. This should not be described to our public as altruism or charity or international goodwill. This is forward defense of our interests in not having to take large refugee flows. It is forward defense of our interests in being able to export. It is forward defense of our interests in having a world in which there are not pandemics that come from abroad again. It is forward defense of our interest in there not being revolutionary situations in which our military has to be introduced. It is forward defense of our interests in terms of hurricanes not destroying our coastal cities. It is forward defense of our interests in terms of the world remaining at peace. And much of it is forward defense of our interests that asks nothing of our taxpayers, because it's voluntary debt relief or it's SDRs or it's IMF quota increases that asks next to nothing of our taxpayers. And there is a case to be made. I actually have studied very substantially the politics of the Marshall Plan period. And I am convinced that more than any bunch of explaining about how this was our enlightened interest to have a peaceful Europe after 1,000 years of war, much more important than any of that was the fact that we were making health insurance available through unions to American workers, that we were building the suburbs with mortgage loans, that we were having a Treaty of Detroit that enabled working people and corporations to come together on better lives for working people. And so I believe that if we have the right domestic renewal, elites will be given space for their international project. And if not, they won't. And so that's where a lot of the emphasis needs to go. Second proposition, second proposition, if I might, Tarman, I think we are only slowly appreciating the macroeconomic reality of our time, which is that because more uncertainty, longer lives, and more inequality are driving increased saving. And everything technological is driving towards less and less absorption of saving. My cell phone has more computing power than a $40 million supercomputer used to. The world has an excess of saving. That means its problem is not inflation. That means its problem is not overheating. That means its opportunity is to deploy those savings to do the huge number of things, from fighting global warming to protecting against pandemic, that have an immense social return, even if they may not have a high private return with a standard business model. And it is that to which our policy efforts in all of its very dimensions need to be turned. And the sooner, just as we needed a new policy paradigm after the inflation of the 1970s, because the previous prevailing Keynesian paradigm had run its course, the inflation targeting, inflation control, stabilize the business cycle paradigm has, I believe, now run its course. And I hope that through seminars and dialogues and debates, and I'm sure that many of my views are not right in their particulars and will be refined through discussion and argument, but I hope that we can see that need for a new paradigm and how it needs to find expression in mechanisms that are about generating much larger north-south capital flows. Thank you.
Thank you very much. I'd like to thank all our panelists, and whilst I hand over to Jacob, just to say that I think we have reasons for optimism in everything that our speakers have said, everything that Kristalina was talking about. Let's aim high, not for the lowest common denominator, as you put it, but let's aim high. Let's aim for that forward defense of a global order that serves all our national interests, quite apart from preserving a sense of humanity. Over to you, Jacob, for final words.
Thank you very much, Tharman. And ladies and gentlemen, we have now reached the end of our time together. Please join me in virtually thanking the wonderful speakers and panelists that have led us in this stimulating discussion of the most important issues of the global economy today. The International Banking Seminar of the Group of 30 has now been in operation for about 35 years. I've attended most of them, and I can testify that it has become, over the years, one of the important highlights of the meetings of the IMF and the World Bank. And one of the reasons is that it brings together leading figures like you have seen today, from the private sector, public sector, from all 4 continents, that speak to us directly. Where else can you get within 2 hours direct presentations by the president of the ECB, by the governor of the Bank of Japan, by the governor of the People's Bank of China, and by the governor of the Bank of England, by the managing director of the IMF, and by the former US Treasury Secretary, by the minister from Ghana, and for the governor from the Banco de Mexico, and all under the very skillful chairmanship of our dear and very esteemed chairman and colleague, the senior minister and chairman of the Monetary Authority of Singapore, Tharman. So it is in this regard that while this virtual IBS has been a success, I very much hope, together with you, I assume, that by next year and in the future, we will be able to convene again in person and renew what has become the spirit of the Group of 30. If I may, let me make a few observations on the current work of our group, and several reports are to be highlighted. First, last week, the group launched the mainstreaming the transition to a net zero economy, an important contribution on climate change and finance, chaired by Mark Carney and Janet Yellen. The report and its recording of the presentation are to be found on our website, the Group of 30 website. On Wednesday last week, Guillermo Ortiz and Larry Summers released a preliminary report. Some of its conclusions were presented today by our friend Larry, the title of which is Sovereign Debt and Financing for Recovery After the COVID-19 Shock. And finally, in early December, co-chaired by Mario Draghi and Raghu Rajan, we will issue another report on corporate sector revitalization in the post-COVID-19 era. Earlier, we also issued digital currency and the like. So as you can see, the group has been kept busy during 2020. And I very much hope that these contributions are going to stimulate further discussion. The G30 appreciates very much the support of almost 100 institutions, public and private, from all over the world that make our work possible. Many of you are with us today, and I express again thanks and appreciation. You can follow the reports, events, and recent members' articles of the G30 on our Twitter @Group30, and we look forward to connecting with you there. And finally, a traditional paragraph. We want to thank the G30 staff, Stuart McIntosh, Desiree Maruka, Emma Prohl, and Melissa Golding for their work to make this virtual event success. Please stay engaged. We hope to see many of you at the G30 events going forward, both online and one day, hopefully soon, in person. Next year, the International Banking Seminar is scheduled to be hosted by the Bank Al Maghrib in Marrakesh, Morocco, along with the IMF and World Bank annual meeting. As decisions are taken in this regard, we will be sure, of course, to keep you informed. Thank you very much for participating. And you know, normally at this stage of the proceedings, I wish you safe travel. But this year, I think we need to be more ambitious. And I wish you stay well, keep health, in good health, and travel less. Thank you very much.